All right, so today I'm going to cover some common terms seen in dividend investing. I'm going to assume most people know what a dividend is, but if not, it's virtually an amount of money a company will pay you on a quarterly, weekly, monthly basis when you own stock in their company. So obviously, some people are huge advocates of this approach, like Warren Buffett or Benjamin Graham, who wrote the book The Intelligent Investor. It's a pretty dense book, but I would definitely recommend it for those that are interested in taking a more personal approach in their investing journey. I split my time between reading the actual book and listening to a free audiobook that I got from my library. So this is by no means going to be a complete list in this video. I'd love to hear from anyone else in the comments below on what they think are some key terms and things to look for when investing into stocks, ETFs, or anything else. So first things first, we'll cover what type of dividend investor are you? So typically you're seeing two types of dividend investor. You're looking at dividend growth investing versus a high yield investing strategy. And so dividend growth investing is mainly focused on companies that are consistently increasing their dividends over a long period of time. And so you're really aiming for long-term income growth and capital appreciation of your investments. And this is mainly for investors that have that long-term investing horizon, someone that has 10, 20, 30 plus years to invest their money and see as it grows. So mainly you're targeting stocks that have a moderate dividend with current yields in that 1 to 3% range, but they have strong dividend growth and a history of strong dividend growth, so 5 to 10% annually. You can also look at a lot of dividend kings and aristocrats, which honestly you can just find on Google with a simple Google search. So you can see companies like Coca-Cola or Johnson and Johnson. Mainly companies in the S&P that have 25 plus years of dividend increases. So that's a great place to start and start looking at positions potentially in that space. But yeah, you're always going to be sort of reinvesting into these positions through their dividends that you get paid out, reinvesting those, continuing to build on your positions and so on and so forth until you need that money in the future. So you're really just trying to maximize your dividend income for future you rather than current you. High yield investing is a little bit different. This is going to be targeting stocks or funds with higher current dividend yields. And so instead of 1 to 3%, you're looking at 6% plus. So you're mainly looking for immediate cash flow, often to replace some amount of your income or all of your income. So this is mainly for investors that are either retired or maybe 5 to 7 years or under towards their retirement. So, or it's just people that are looking for an additional sort of income stream and seeking some more passive income. Two main types that a lot of people are talking about are REITs and covered call ETFs. So REITs are real estate investment trusts, which are legally required to return a minimum of 90% of their taxable income to investors in the form of dividends. So obviously this can be a major draw for investors that are seeking sort of higher income from their positions. Same thing with covered call ETFs. So there's one like JEPI from JP Morgan that has like a 7 to 9% yield on average, which are generating income by selling call options on stocks. This will boost your payouts, but it can limit the upside if the stock starts to rise sharply. So there are pros and cons to each approach. If we look at high yield investing, some pros obviously is that high immediate income. You need to invest a lot less compared to that dividend growth mindset to have the same monthly payments in dividends, like hundreds of thousands versus millions in some situations. So if that's something that you need in the near term, this is a great approach for starting to boost your income. Some cons to this though are you're limited in your dividend growth and your capital appreciation of your positions. Typically, like you can see, these stock prices start to stagnate or drop. There are higher risks of dividend cuts. High yield isn't guaranteed in the future, and they also could have some higher tax implications. So depending on how they're taxed, it could be just your general income, and we'll dive into that in a little bit. But pros and cons for dividend growth. Some pros are, you typically have that stable growing income. There's lower risk of dividend cuts because they usually have really strong free cash flow. Um, there's the upside potential with stock price appreciation, and they could potentially be more tax efficient. So obviously, there's pros and cons to each. You have to figure out what fits into your time horizon. So now we'll dive into some common terms. This is just a starting point, but definitely some things to be aware of when you're researching a potential investment position. So first things first, dividend yield. We kind of already talked about this with both mindsets for investing. But dividend yield, it's going to be the annual dividend per share divided by the current stock price. So this is showing the income generated per dollar invested. So hypothetically, if a stock costs $50 and you pay or it pays you $2 in annual dividends, 2 divided by 50 times 100 converted to a percentage, you're at a 4% dividend yield. And so high yield investors are typically targeting 6% plus, whereas growth investors accept that 1 to 3% range for future growth within the company. Dividend payout, this is going to be the total annual dividend paid per share, which is pretty self-explanatory. So say you're getting $2 in a dividend payout and they pay quarterly, you're getting 50 cents per quarter. And then CAGR is compound annual growth rate. So this is going to be the annualized rate at which a dividend or an investment grows over time. So this is based off of historical data. It's not a prediction for the future, but typically growth investors are seeking 5 to 10%. High yield investors can accept smaller 1 to 3% yields. All that's fine. Some more terms, yield on cost. This is going to be the current annual dividend divided by the original purchase price. So this kind of shows your income relative to your initial investment. So with that example that we just kind of talked about, if you buy a stock for $50 and you have a $2 dividend, that's a 4% yield. Say 5 years down the line, now you're getting paid $3 for that in dividends, and you still have that $50 position. Now you're doing, instead of 2 divided by 50, 3 divided by 50, your yield on cost is 6%. So this shows sort of your dividend growth over time. In my opinion, it's great to be used as sort of a personalized performance metric. It can also help keep you committed to long-term holdings of positions. So you want to see this grow over time to make sure that you're in a good position. You want to see your yield on cost at 5 to 10% in 10 years, hypothetically, or 10% plus in 15 to 20. Free cash flow. This is extremely important to look at when you're researching companies. So this is the cash a company generates after operating expenses, capital expenditures. And so usually the question that's asked is, where is the company putting their additional money? So free cash flow can be reinvested into the business for organic growth. It can be used for mergers and acquisitions. It can strengthen the company's position by paying off debt. You can also have the company do share buybacks, or they can return it to stockholders in the form of dividends. So really important to look at free cash flow. If a company's generating 100 million in free cash flow and pays 60 million in dividends, and then like their history shows, all of a sudden, instead of 100 million in free cash flow, now they're at 80, now they're at 70, now they're at 60, now they're at 50, right? They still have to pay these dividends out to their stockholders. So they have to start to get creative on how they're doing that. They might cut their dividends, things like that. So always be aware of where a company's free cash flow stands. And then payout ratio. This is the percentage of earnings paid as dividends. So lower ratios suggest more room for growth. It helps kind of assess the stability of their dividends and financial health of a company. Typically, growth investors prefer under 60%. High yield investors can tolerate more in the 70 to 90%. But ideally, you're looking for companies that have a payout ratio of less than 60%, because you want them to continue to grow as a company and use their money to their advantage while also paying you out. And now the fun part, taxes. I am in no way a tax expert. I know very little on taxes, but some general information on taxes for stocks. We'll go into it a little bit. Honestly, Google can be your best friend with this, but qualified dividends, these are going to be dividends from U.S. companies that are held for 61 plus days, and they are typically taxed at a long-term capital gains rate. So this is going to be 0%, 15%, or 20%. Knowing if what you're investing in, and you can Google it, like knowing if the company or the ETF or whatever you're investing in gives you qualified dividends is really important, because it can drastically change how much you're paying in taxes. Whereas like non-qualified dividends, these are typically like REITs or things like that, but you are going to be taxed on ordinary income taxes. So potentially, depending on your tax bracket, you could be getting taxed anywhere between 10 and 37%. So just be aware of what you're investing in, what type of dividend they are. And then there's obviously return of capital too. So some positions like cover calls might give you return of capital, which is mainly tax deferred, but you will pay eventually. And so figure out what suits you, what your goals are, what your time horizon is, when you want to retire, and work from there. We obviously only covered a bare minimum in this as a little cheat sheet, but we'd love to hear what else is important to all of you in the comments below. And in future videos, we'll take some of this information to help build a picture on specific stocks and things like that. So that's everything for today. See you later.